Alright dear students, we are going to do consolidation now. And remember one thing, whenever you see this term consolidation, that simply means group accounts. Now, group account means that you are going to group two separate accounts. So when you talk about the basic consolidation, what you are going to do, you'll be taking the accounts of the parent, you will be taking the accounts of the subsidiary, and then you are going to consolidate these two accounts in order to make consolidated financial statements. So consolidation means that you are going to group, you are going to consolidate, you are going to amalgamate the accounts of parent and the subsidiary in order to make consolidated financial statements. Now, why we will be preparing the consolidated financial statements? Who will be preparing the consolidated financial statement? We'll be discussing this thing in the other lecture. And who will be preparing the financial statement? Who is exempt from preparing the consolidated financial statements? All those details will be discussed in a separate lecture. In this lecture, we are going to focus on the basic consolidation. And when you talk about the basic consolidation, that means you're going to study consolidated statement of financial position. You are going to study consolidated statement of profit or loss. You are going to study the associates. So these are the things which you are going to study in the basic consolidation. And remember one more thing, whenever you see the consolidation, the basis of the consolidation is the single entity concept. Single entity concept. Now this is something different from the separate entity concept which you studied in your basic accounting paper. We are discussing single entity concept. Now single entity concept simply means that actually there is a company which is a parent company, and this company is also known as the holding company. So they're holding or they're having more than 50% share in a company which is known as subsidiary. So when a company is having more than 50% shares in another company, so the company which is holding the share is known as the parent, and the company in which they have the shares is known as the subsidiary. So by acquiring or by purchasing more than 50% shares in this company, they are having the control. And control simply means that they are able to govern their financial and operating policies. I've already told you that the details of these control and all those things will be discussed in the other lecture. In this lecture, we are going to focus on the numerics rather than the theory. The theory will be covered in a separate video. So parent is having more than 50% shares in a subsidiary, and by having more than 50% shares, they have the control. Now control means they can decide what this company is going to do. So when this company, which is known as the parent company, is deciding what the subsidiary is going to do, that means in substance they are a single entity. Like for example, if I have a company A and then I have a company B, and I am deciding whatever company A is doing and whatever the company B is doing, then for me A and B is actually both of the companies are a single entity, because I am deciding what A is going to do, I am deciding what B is going to do. So in substance, because they are having the control, because they are having more than 50% shares, in substance they are a single entity, and that is why the parent is required to prepare the consolidated financial statements. I'm not saying these are not separate companies. Parent is a separate company, subsidiary is a separate company. Parent will be preparing the individual financial statements, subsidiary will be preparing the financial statements. But when you talk about who is going to publish the consolidated financial statements, so it is going to be parent which is going to publish the consolidated financial statements. And the basis for the consolidation is the single entity concept, because this company is having control over other companies. They are deciding what other companies are doing, so they should prepare the consolidated financial statements and they should publish the consolidated financial statements. So the basis of the consolidation is the single entity concept, and there's a reason why I am emphasizing on this concept, because we'll be discussing this thing again and again when we are dealing with different concepts of the consolidation. So consolidation is done based on the single entity concept. Now, when this parent company is having 20 to 50% shares, not more than 50%, 20 to 50% shares, that means they will not be having the control, because control is obtained by acquiring more than 50%. So when they're having 20 to 50% shares, they will be having significant influence. That means they can participate in the financial and operating policies, but they are not going to control the financial and operating policies. They are not going to govern the financial and operating policies. So if a company is having 20 to 50% shares in another company, then that company will be known as associate. And remember one thing, we are not going to consolidate associate. That is why when I have written group accounts, I have written parent and the subsidiary. I have not written associates. Although associates will be presented in the consolidated financial statement, but they will be having a different way of presenting in the financial statements. We are not going to consolidate the associate just like the subsidiary, because the parent company is not having the control over the associate, they are having the significant influence. So what we are going to do is we will be presenting the associate in the consolidated financial statement, which is known as equity accounting, but we are not going to consolidate it. The consolidation will be done of subsidiary with the parent. An associate will be presented in a different way in the consolidated financial statements, but we are not going to consolidate the assets and the liabilities of the associate just like we are doing with the subsidiary along with the parent. So this is the important thing you need to understand, that the consolidation is done on the single entity concept, and there are two things you need to remember. One is the subsidiary, and subsidiary is the company which is being acquired by the parent in a way that they have more than 50% shares. Associate, they are having 20 to 50% shares, thereby they have the significant influence, and this associate will be presented in the consolidated financial statement in the form of equity accounting, but it is not going to be consolidated like subsidiary. So this is the main thing you need to understand. And now we will be first of all starting the consolidated statement of financial position. We'll be talking about the consolidated statement of financial position. So first of all, you will be looking at the basic principles of the consolidated statement of financial position. These are the things you need to remember. So if you remember these things, it will be quite helpful to make the consolidated financial statements, consolidated statement of financial position. So the first thing you need to remember, sorry, is the cost of investment in the subsidiary shown in the parent's statement of financial position is removed, as the single entity, the group, does not have an investment. Remember one thing, when the parent is doing an investment in the subsidiary, so in the individual books of the parent, that investment is recorded as an asset. And this can be clearly understood by the concept, like if one company buys the shares of another company, So for the acquirer, that is going to be the financial asset. And for the acquiree whose shares are acquired, for them that will be equity. If the parent is acquiring the shares of the subsidiary, for parent that investment is going to be accounted for as an asset. So in the assets, there will be the financial asset. That means this is actually the investment which has been made by the parent in the subsidiary. And the subsidiary shares are acquired. For them, this is equity. This is the basic concept you need to remember. That when you buy the shares of another company, for you, that is the financial asset because you have bought their shares. For you, that is an asset, that is a resource. You can sell those shares, you can keep those shares, you can receive the dividends, you can have the capital appreciation in it. But for them, that is the equity because you have bought their shares and their shares are their equity. For you, it is going to be an asset. So when you are consolidating, that means you are consolidating parent plus subsidiary. So you take all the investments, of the parent because parent may have done investment in many companies. You take all the investments of the subsidiary because the subsidiary may have investment in other companies. But you are going to deduct that investment which has been made by the parent in the subsidiary. So you will deduct the parent's investment in subsidiary. You're going to eliminate this investment because we are doing the consolidation based on the single entity concept, and one company does not invest in itself. One company does not invest in itself, like they cannot buy themselves. So we are doing the consolidation based on the single entity concept. So one company does not buy itself. That is why we are going to eliminate the parent's investment in the subsidiary. Let me repeat this thing. Why we are taking the investment of the parent? Because parent may have investments in many companies. The subsidiaries may have investment in other companies. So we are going to eliminate the investment which has been made by the parent because this parent investment in subsidiary is included in parent's individual financial statements. So we are going to deduct that thing. Other than this, all of the investments will be consolidated. And the reason is the single entity concept. So in the parent books, the investment sorry, that has been made by the parent in the subsidiary is recorded as the financial asset, as an investment. So when you are consolidating the investments, you're going to remove the parent investment in the subsidiary based on the single entity concept. And then on the line by line basis, you will be adding the parent assets with the subsidiary assets. Based on the line by line basis, you will be consolidating the parent's liabilities with the subsidiary's liabilities. But when it comes to equity, when you're talking about the share capital, share premium, when it comes to equity, you are going to take the equity of parent only. Remember, equity of parent only. We are not going to consolidate the equity of the subsidiary. And what is the reason behind that? As the accounts are being prepared for the group owners, that is the shareholders of the parent. So that is why we are not going to consolidate the equity of the subsidiary. We'll be only taking the equity of the parent. So these are the basic principles you need to remember when you are making the consolidated statement of financial position. So the first principle is you are going to eliminate the parent's investment in subsidiary, and rest all of the investments will be consolidated. This is the exam focus point because some students they directly remove all the investments. No, you are not going to remove all the investments. You're going to remove only the parent investment in the subsidiary, which is the investment made by the parent, which is the consideration that have been given by the parent to the subsidiary. And rest, you will be consolidating all the assets, you will be consolidating all the liabilities, and you will be taking the equity of the parent only. Equity means share capital, share premium, etc. You will be taking the equity of the parent only. The reason behind that is that you are preparing the consolidated financial statements for the users of the parent. Remember one thing, that consolidation is done on the line by line basis. Now, the line by line basis means you will be taking the assets of the parent and then you will be amalgamating them with the subsidiaries assets. You will be taking the liabilities of the parent and then you will be adding up the liabilities of the subsidiary with the parent. So consolidation is done on the line by line basis. Right in front of you there is an illustration, there is an example which shows how we are going to consolidate. So this is the periwinkle, which is the parent, and then sandfly, which is the subsidiary, and these are the consolidated financial statements, and specifically this is consolidated statement of financial position. So you are going to take the non-current assets of the parent, which is 35,000, and then you are going to accumulate this with that of subsidiary, and the total non-current assets are going to be 45,000. And this is the investment which the parent has made in the subsidiary, 10,000. So they have bought the shares in the subsidiary for 10,000 consideration. And remember, we have studied this thing, that when we are making the consolidated statement of financial position, we are going to remove this investment. So this is going to be removed, this is going to be eliminated. In this example, we are not having in detail the other investments of the parent as subsidiary, but in exam question you may have other investments of the parent and the subsidiaries. Similarly, you take the current assets, although there are usually adjustments in the current asset, but right now we are not talking about adjustments. We are simply amalgamating parent current assets with the subsidiary, and then you will get 14,000. So the total assets are going to be 59,000. And then you have the share capital, and I've already told you that you are going to take the capital of the parent only, and we are not going to consolidate the equity of the subsidiary. So we'll take the parent only capital, which is simply 25,000, and then we'll accumulate the liabilities of parent with the subsidiary, and this is going to be 16,000. So based on the principle of accounting equation, assets should be equal to the liabilities plus capital. So we'll write the 59,000 over here, and we'll calculate the retained earning in this example as a balancing figure. Now why we are doing that, you will understand that thing later on shortly, because retained earnings is known as group retained earnings, which has a separate detailed working. And this group retained earnings is calculated from the workings, but for right now we are just taking this thing as a balancing figure. All right, so now we'll be moving further and we'll be talking about each and every component of the consolidated statement of financial position in detail, each and every component. So first of all, you have the non-current assets section right in front of you. So in the non-current assets section, first of all, you have the PPE, property, plant and equipment. And see, there are some adjustments right in front of you. And I'm going to drag it down in order to make it more clear. So when you're talking about the property, plant and equipment, you're going to take the PPE of the parent and then you will take the PPE of the subsidiary. But then you have to do some fair value adjustments. Now the fair value adjustment means you have taken this parent property, plant and equipment from the parent's individual financial statement, which shows the carrying value. Similarly, you are taking the property, plant, and equipment of subsidiary from subsidiary's individual financial statement, again, which shows the carrying value. But when the subsidiary is selling you the company, when they are selling you the company, they are selling you the assets. Their assets may be worth different than what is shown in the carrying value. That means you have to do some fair value adjustment because subsidiaries property, plant and equipment may be different from what is shown in the what is shown in the individual financial statements. So this property, plant and equipment which you are taking is from the individual financial statement which shows the carrying value. For example, the carrying value is 100, but the fair value is 150. That means there is a fair value uplift which you should show in your consolidated financial statements. Similarly, it can be vice versa. For example, it can be 80. Now, in that case, you have to do a downward fair value adjustment in the subsidiaries, property, plant, and equipment. So whatever. It can be upward, it can be downward. So what you are going to do is take the property, plant, equipment of parent, and then subsidiary, and then plus minus fair value adjustment, whatever, upwards or downwards. So you have to add or less that thing over here. And then there will be the impact of the depreciation minus slash plus depreciation. Now, when there is a fair value adjustment, for example, over here, the carrying value is 100, but the fair value is 150. The depreciation has been charged on 100. It should have been charged on 150. So that means you have to deduct further depreciation when there is an upward revaluation or upward fair value adjustment. Similarly, if there is downward, the depreciation would have been charged on 80, but it has been charged on 100. That means you have to add back the excess depreciation when there is downward fair value adjustment. So remember one thing, when there is upward fair value adjustment, the extra depreciation will be deducted. When there is downward fair value adjustment, the excessive depreciation will be added back. Now, in order to grab this concept, we have an example. So this is an extract right in front of you. Statement of financial position as at 30th September 2008. And then you have the property, plant, and equipment of the parent and the subsidiary. So 40,600 and 12,600. The following information is relevant. At the date of acquisition, the fair values of the Sophistic, which is the subsidiary, assets were equal to their carrying amounts, with the exception of an item of plant. All the assets, the carrying values were equal to the fair values, except for the plant, which had a fair value of 2 million in excess of its carrying amount. That means there is upward fair value adjustment. It had a remaining life of 5 years at that date. Sophistic had not adjusted the carrying amount of its plant as a result of the fair value exercise. Now, what you are going to do is property, plant, and equipment of the parent plus subsidiary plus fair value adjustment, because here we have upward fair value adjustment, and minus fair value depreciation. So the parent's property, plant, and equipment is 40,600 plus subsidiaries is 12,600, and then there is a fair value uplift of 2,000. I'm taking in 000, 2 million, so the working is supposed to be in 000. And then you have to deduct the depreciation. So how much is the depreciation? Assuming the subsidiary is acquired at the start of the year, so 2,000 is the fair value uplift, and remaining life is 5 years. So the depreciation will be 400. So 400 will be deducted from here. If there is the mid-year acquisition, if mid-year acquisition, that means subsidiary has been acquired mid-year, then you have to do this pro rata by multiplying with months by 12. But here I have assumed that the subsidiary has been acquired at the start of the year, so I have deducted the full depreciation from here. So this is the important thing you need to understand, that when there is a fair value uplift, you will be deducting the depreciation. Now I have another example. So statement of financial position as at 30th September 2008, and the property, plant, equipment, again parent and subsidiary. The following information is relevant. At the date of acquisition, the fair values of the Sanfords, which is the subsidiary, assets were equal to their carrying amounts, with the exception of its property. This had the fair value of 1.2 million below its carrying amount. So there is a downward adjustment and had a remaining life of 8 years. Sanford has not incorporated this in the financial statement. So again, you're going to take the property, plant and equipment, which is parent plus subsidiary, and now minus fair value adjustment and plus depreciation, because here you are going to add it back. So parent's property, plant, equipment is 25,500, and then you have subsidiary 13,900, minus 1.2 million is 1200 because I'm working in 000, and then the depreciation impact. So 1200 divided by 8. Again, if it is mid-year acquisition, then you will be taking months by 12, because when you divide 1200 by 8, it gives you the full year depreciation. So 1200 divided by 8, it gives you 150. So you're going to pro rata this thing if there is mid-year acquisition. In this question, in this example, in this illustration, I'm assuming that the subsidiary has been acquired at the start of the year. So these are the two examples of upward fair value adjustment, and then you have the downward fair value adjustment. And then you will be discussing the second thing, which is the goodwill. So we are done with the property, plant and equipment, and the next thing we are going to study is the goodwill. Although the goodwill is calculated from working number 3, but we are going to discuss some other perspective of the goodwill in this slide. Now, when you are acquiring a subsidiary, or when a parent is acquiring a subsidiary, obviously they need to know the worth of the subsidiary. And when they are looking at the worth of the subsidiary, the first thing they will be looking is what are their net assets. And net assets means assets minus liabilities. So the first thing they will be looking is the assets minus liabilities, which is known as the net assets. Now, when they are buying the subsidiary, maybe the subsidiary is demanding more than what their net assets worth. Like for example, their net assets worth is 12 million, but they are saying that they will be willing to sell the company in 20 million. 20 million is the demand. Now obviously there's a difference between the 20 million and 12 million, which is 8 million. Now why the parent company will be paying them more than what their net assets worth? So there may be some good reasons for that. In order to understand those good reasons, just keep it in your mind that whenever a parent company is buying a subsidiary and they're willing to pay more than what their net assets worth, so they are paying for the good things, and those good things are not recognized by the subsidiary in their financial statements. For example, if they have the key employees, now the key employees are not recorded in the financial statements, but obviously over the time they have trained their employees, they have spent something on them, so they will be charging a premium for those things. Maybe they have the good customer base. So when they have the good customer base, they already have many customers, and when you are buying them, you will straight away have the access to those customers. So they have contracted with those customers in those years. Now they will be charging a premium for that. Maybe their location, maybe they have their outlets at some strategic locations, which is beneficial for them eventually and for you now. So you will, and again, these key employees and customer base and locations, these are the things which does matter, but they are not recorded as an asset in their financial statements, but they will be charging you for those things. So remember one thing, they will be charging you for those things for those good reasons. The parent company may be willing to pay them more than what their net assets worth. This is known as the positive goodwill. When payment is made more than subsidiaries' net assets, and when you are paying more, you will be recording this thing as an intangible asset, a separate head as a goodwill in your non-current assets. And because the goodwill have the indefinite lives, so it cannot be amortized, it should be tested for impairment according to IAS 36. But it can be a vice versa case. For example, a parent company is buying a subsidiary which is a struggling company. They are already in financial pressure, they are about to die, and the parent company is buying them, and they will be doing some management changes, and then they will be selling that company, for example. Now the subsidiary is a struggling company, and they are willing to sell their company even below what their net assets worth. So when payment is made less than net assets, then that is known as the negative goodwill. That means the parent company is buying the subsidiary at a lesser amount, even lesser than the net assets. And this is also known as the bargain purchase. That means you're having a benefit on the bargain. You're buying them cheaper. Now, for example, if their net assets worth is 12 million and you are buying that company in 10 million, which is the consideration, you're paying 10 million for the assets which worth 12 million. So you are having a benefit of 2 million. Now this benefit should be recorded as an income in the consolidated statement of profit or loss. So positive goodwill is recorded as an asset, and negative goodwill, which is also known as the bargain purchase, is recorded as an income. So what I have shown you over here is the positive goodwill, and it is subject to the impairment. And then you will be having investment. You will take the investment of the parent plus subsidiary, but you will be eliminating the parent investment subsidiary, which we have already discussed. And then there is another thing, which is investment in associate. I have already told you that we are not going to consolidate the associate just like subsidiary, but that associate will be presented in the consolidated financial statements, and the treatment followed is known as the equity accounting. So again, there is a working for this thing which we'll be discussing shortly. Alright, so now we'll be talking about the associates. And the associate means when the parent company has acquired 20 to 50% shares in another company that is known as the associate. Now, when it comes to associate, there is no control. Instead, there is significant influence. There is no control. Instead, there is significant influence. And because there is no control, so no consolidation is done. You cannot consolidate the associate just like you are doing the subsidiary, like you are amalgamating the assets of the subsidiary with that of parent. So you cannot do this thing with the associate. So no consolidation. You will be doing the equity accounting. Now, equity accounting means that one figure will be recorded in the consolidated statement of financial position and the other figure will be recorded in the consolidated statement of profit or loss. So one figure will be recorded in the consolidated statement of financial position. Another figure will be recorded in the consolidated statement of profit or loss. And the concept of equity accounting applies where there is significant influence rather than control. So as I've already told you that associate will be presented. Now we'll be talking about first of all in the statement of financial position how this is recorded. The first thing you need to know is the cost of investment. Now cost of investment means the consideration which has been given by the parent company to the associate. This is the amount which has been paid by the parent company. And now after the acquisition, whatever the associate gonna earn is known as the post-acquisition profit. And in that post-acquisition profit, there will be the share of the parent. And this share of the post-acquisition profit will be added to the value of the parent, which is the investment made by the parent in the associate. And if there is any impairment, that will be deducted. If there is any unrealized profit when the parent sells to the associate, that will be deducted. And if there are any dividends which have been paid by the associate to the parent, that will be deducted as well. And this net figure will be recorded in the consolidated statement of financial position. So remember, we'll be starting with the amount which has been paid by the parent to the associate, and if there are post-acquisition profits, that will be added. If there are losses, similarly that will be deducted. Impairment will be deducted, unrealized profit will be deducted, dividends will be deducted, and this figure will be recorded in the consolidated statement of financial position in the non-current asset, and the head is going to be investment in associates. So this is the first thing you need to understand, the associate figure in the consolidated statement of financial position. And then there will be the associate figure in the consolidated statement of profit or loss, which is simply the post-acquisition profit, again this thing, because the profit is recorded in the statement of profit or loss, and then any impairment will be reported. This net figure, post-acquisition profits minus impairment, this will be recorded in the consolidated statement of profit or loss. And I'll be showing you this figure as well when we reach consolidated statement of profit or loss. So equity accounting is done in relation to the associate because there is no control, instead there is significant influence, so no consolidation should be done. And there should be the equity accounting, which means one figure should be recorded in the consolidated statement of financial position, another figure should be recorded in the consolidated statement of profit or loss. Now we have an example. On 1st October 20x3, remember the date, 1st October, Picant, which is a company, acquired 40% of the equity shares of Adler. So 40% is in between 20 to 50%. That means this Adler is an associate. Paying $4 in cash per acquired share and issuing at par $100 7% loan note for every 50 shares acquired in Adler. Now that means there are two considerations. So first of all, we have to calculate the consideration, which is the cost of investment as well. All right, so the first consideration is the cash. Now how the cash is being paid? 40% shares are acquired and $4 per share has been paid. So we have further details in which we see the equity balance of the associate is $5,000 and their one share worth $1, so there are 5,000 shares. So total share are 5,000, out of which 40% has been acquired and per share $4 has been given. Okay, this is the amount of the cash. And the next is the loan notes. And how the loan notes are being issued? Again, 5,000 into 40%. These are the total shares which have been acquired. So for every 50 share, $100 loan note. Now we need a calculator to solve this thing. So 5,000 into 40%, 2,000 shares, and multiply by $4. So the cash is $8,000. And now we'll calculate the loan notes. So 2,000 shares have been acquired. So for every 50 share, $100 loan note, which means 4,000. So the total consideration which has been paid by the parent to the associate for acquiring this 40% chunk is $12,000. And then we have further data. Retained earnings of the associate at 1st April it was 15,000 and this year they have made the profit of 6,000. So out of 6,000, now this 6,000 is for full year from 1st April 20x3 to 31st March 20x4. But the Picant has acquired the associate on 1st October. So we'll take October, November, December, January, February, March, 6 months. So 6,000 is the total profit. 40% belongs to the parent, and then you will take 6 by 12. So how much it is? 6,000 into 40%, 2,400 multiplied by 6 divided by 12. So it's 1,200. This 1,200 is the post-acquisition profit. This 1,200 is the post-acquisition profit. Impairment tests were carried out on 31st March, which concluded that the value of the investment in Adler was not impaired, so there is no impairment. So when you do equity accounting, in the consolidated statement of financial position, there will be cost of investment, which is 12,000, and plus post-acquisition share, which is 1,200. So that means 13,200 is the figure which will be recorded in the consolidated statement of financial position. And in the consolidated statement of profit or loss, there will be the post acquisition profit only because there is no impairment, and 1200 will be recorded over there. So this is how you are going to calculate the associate. All right, now we are moving further, and we'll be talking about the other part of the consolidated statement of financial position, which is the current assets. We have already discussed the non-current assets, and now we'll be discussing the current assets. The first thing we are going to discuss is the inventory. And let me again drag it down, inventory. So what is written? Parents inventory plus subsidiaries inventory and plus goods in transit. Now what is this goods in transit? Goods in transit means either the parent or the subsidiary has sent the goods to each other. For example, parent has sent the goods to subsidiary, but subsidiary has not yet received. This is known as the goods in transit. So the treatment for goods in transit is that obviously they have not received it, but they will receive it obviously at some point in future. So just assume that this inventory has been received. So if you assume that this inventory has been received, what is going to be the double entry? Debit inventory, and credit will be the corresponding payable, because they have not recorded the inventory as well as the corresponding payable. So what we're going to do is we make them record this in inventory because that will be received at some point in future along with the corresponding payable. So this is the treatment of the goods in transit. Parents inventory plus subsidiaries inventory, which does not include the goods in transit because we are taking the consolidated, so it does not make any difference whether parent is selling to the subsidiary or subsidiary is selling to the parent, because ultimately we are taking the total figure. Goods in transit will be added and there will be a corresponding payable which will be included in the current liabilities. I'll show you that when we reach to current liabilities. And minus unrealized profit. Now what is this unrealized profit? Again, we'll recall the concept of the single entity. The single entity concept means we are doing the consolidation based on the single entity, that parent and the subsidiary is one entity, and one entity does not sell to itself, and one entity does not make profit from itself. So if the parent has sold goods to the subsidiary, or the subsidiary has sold goods to the parent and they have made a profit on that, and that profit is still in stock, that is known as the unrealized profit. So profit on goods which is still in stock. So because we are doing the consolidation based on the single entity, this unrealized profit should be removed. Unrealized profit should be removed. And the focus point over here is the profit on goods which is still in stock. Any inventory which has been sold to the third party, that profit has been realized. Unrealized profit is only on the goods which are still in stock. So in the exam, when you have such situation regarding the unrealized profit, so there will be some data that this amount of goods have been sold by the parent to the subsidiary, and then there will be the markup margin story over there. Markup margin. In the markup, the cost of sale is 100%. And in the margin, the sale is 100%. So you need to remember this basic accounting concept, which you studied in your incomplete records, and that will be applied over here, that markup or margin thing. So you have to calculate this unrealized profit, and that is going to be removed from the group inventory. So when you are dealing with the inventory, take parents inventory from individual financial statements, take subsidiaries inventory from individual financial statements, and then there will be the goods in transit, which has not been recorded, so you're going to record it along with the corresponding payable, and unrealized profit will be removed. And there's one more thing you need to remember. There's no concept of unrealized loss. Loss is not unrealized. Loss is realized every time. So there's only concept of unrealized profit. There's no concept of unrealized loss. And unrealized profit is only on the inventory which is still in stock. All right, we have an example. So you see the current assets we have of the parent and the subsidiary, and then we have the current liabilities of the parent and the subsidiary. Sales from Sanford, which is the subsidiary, to Premier, which is the parent, throughout the year ended 30th September 20x0 had consistently been 1 million per month. Sanford made a markup on cost. Now markup means where the cost of sale is 100%. So the selling price will be 125%. In the markup where the cost of sale is 100%, when the markup is defined, now the selling price will be 125%. Premier had 2 million at the cost to Premier of inventory that has been supplied in the post-acquisition period by Sanford as at 30th September. Now, the subsidiary has sold goods to the parent, and they have sold the goods worth 2,000. 2 million, we are dealing in the 000. This represents 125%, as this is the selling price. We have to multiply it by 25, which is the markup, in order to calculate the unrealized profit. So 2000 divide by 125 and multiply by 25 is 400. So this 400 is the unrealized profit, which will be deducted from here. Alright, now we'll be discussing the trade receivables. Again, I'll show you the trade receivables over here. So parent's trade receivable plus subsidiaries trade receivable minus cash in transit and minus intragroup. Similar to the goods in transit concept, there is the cash in transit. Cash in transit means either the parent or the subsidiary has sent the cash, but that has not yet been received. So what we're going to do is make them receive the cash. When we make them receive the cash, the double entry is going to be debit cash and credit receivables, because when the cash is received, the receivable is derecognized. So this minus cash in transit shows that the receivable has been derecognized. And where it is going to be recognized? In the bank. So in the bank, we take parent bank plus subsidiaries bank plus cash in transit. So we record this cash over here, and then we derecognize the corresponding receivable. And this intragroup means the contra entry, because the parent and subsidiaries are dealing with each other, they are selling goods to each other. So in one's book there will be the receivable, in the other book there will be the payable. And I've already told you that in the single entity concept, one company does not trade with itself. So you have to de-recognize the balances. So what you're going to do is pass the contra entry debit payable, that means de-recognizing the payable, and credit receivable, that means de-recognizing the receivables. So if you see in this example which we were doing, we have already calculated the unrealized profit. Premier had a trade payable balance owing to Sanford of 3,50,000. This did not agree with the corresponding receivable in Sanford books due to 1,30,000 payment made to Sanford, which the Sanford has not yet received, has recorded. This is the cash in transit. So how the cash in transit is recorded: debit cash by 130 and credit receivable by 130. Once you record this thing, then you will be passing the contra entry. This is the balance, debit payable 350, credit receivables 350. So now how you are going to do the current assets? So you consolidate 12,500 plus 2,400, which is the parent current assets plus subsidiaries current assets. Now in the current assets we have, all the inventory, receivables, everything, bank. So we are having an adjustment in the current assets. See, there will be the cash which is being added plus 130, and then there will be receivable which has been de-recognized, and then there will be the unrealized profit of 400, and then there will be the 350 balance. So this is how we are going to adjust, because in this example we are having a total figure of the current asset rather having the breakdown of inventory and all those things. So you take the current assets of the parent plus subsidiary plus cash in transit minus receivables minus intragroup and minus unrealized profit. So what we have done over here is we have clubbed these two things, three things, sorry. All right, and now, yes, the current liabilities 15,000 plus 6,800 minus 350, because this is the only adjustment in the liabilities, which was payables. All right, now we have another example. So we have in the current assets we have inventory, we have trade receivables, we have other current liabilities. At 31st March 2004, Pecant current account with sender was 3.4 million. This is the intragroup balance. This did not agree with the equivalent balance in the sender books due to some goods in transit at 1.8 million that were sent by Pecant but had not been received by the sender until after the year end. So this is the goods in transit. Now the adjustment of goods in transit is debit inventory, credit payables, because we make them receive the inventory of 1,800 and the relevant payable will be recorded. Pecant sold all of these goods at cost plus 50%. Now that means we have to calculate the unrealized profit. So unrealized profit 1,800, this represents 150 multiplied by 50. So 1,800 divided by 150 multiplied by 50 gives you 600. This is the unrealized profit. And once we have done the adjustment of the goods in transit, then we'll be dealing with the contra entry. So the contra entry is debit payable, credit receivable by 3,400, which was their balance. Okay, now we'll be dealing with the consolidation. So consolidated statement of financial position. So first of all, we will be dealing with the inventory. Take parents inventory, which is 10,000, plus subsidiaries inventory, which is 9,000, and then you add the goods in transit of 1,800 minus unrealized profit of 600. Then you take receivables. So parents receivable 6,500 plus subsidiaries receivables 1,500, and then minus 3,400, which is intra-group receivable. Then you have current liabilities. Take parents current liabilities plus subsidiaries current liabilities, and then you will be having this corresponding payable, which should be recorded, and then minus intra-group. So these are the extracts of the consolidated statement of financial position. So remember, in this example, we did the cash in transit, and in this example, we did the goods in transit. So you have to remember how the goods in transit and cash in transit should be dealt. So remember this thing: inventory, parent plus subsidiary plus goods in transit minus unrealized profit. And you have to calculate the unrealized profit by using the concept of markup and margin. Trade receivables, parent plus subsidiary minus cash in transit because the corresponding receivable has been derecognized, and minus intragroup means the contra entry. In the bank, there will be parent plus subsidiary plus cash in transit. Now cash in transit represents the receipt of cash. And when you are recording the goods in transit, there is going to be a corresponding payable as well. Right, so we have discussed the complete asset side, the non-current assets and the current asset. Now we are moving further in the consolidated statement of financial position, and we'll be discussing the equity and the liabilities. One thing to remember over here is that we are going to take the equity shares, including the share capital and the share premium, of the parent only. So when we are taking the share capital, this includes the share capital from the parent's individual financial statement and plus share exchange. Now what is this share exchange? When the parent is buying a subsidiary, they have to make a payment to the subsidiary. And sometimes share exchange is one form of the consideration they are paying. That means the parent is acquiring the share of the subsidiary, and in consideration they are issuing the shares to the subsidiary, which is known as the share exchange. So if the parent company is issuing the shares to the subsidiary, that is known as the share exchange, and that will be part of the consideration, so we have to record those shares as well. Similarly, share premium as per the individual financial statements and plus share exchange, because when you are doing share exchange, if it is more than the par value, that will give rise to the share premium. Because usual entry of issuing the shares is debit cash, credit share capital, and this is up to par value, and credit share premium, which is above par value. So the only difference that will come over here is that because the parent is not receiving any cash when they're issuing shares, instead they are issuing the shares as part of the investment. So debit cost of investment, credit share capital, and credit share premium. And then you will be having the retained earnings, which has the separate working. Then you have the concept of the non-controlling interest. Now the non-controlling interest is the percentage not acquired by parent. For example, if the parent has acquired 60% shares in the subsidiary, then the non-controlling interest is 40%, which means this percentage that the parent has not acquired. Now the question over here is why we will be recording the non-controlling interest in the consolidated statements. Why we are recording the NCI in the statement of financial position, the consolidated statement of financial position. This is the percentage which we have not acquired, and this is something which does not belong to us. Then why we are recording this thing over here? So the answer to this question is that we are consolidating 100% subsidiary. Like if we have acquired 60% shares, then usually we should take 60% of the assets, 60% of the liabilities, but we are not doing that thing. When we are consolidating, we are taking 100% of the subsidiary. We are consolidating 100% of the subsidiary. So when we are consolidating 100% subsidiary, we have to show to our investors that this is the percentage which is not owned by us. Otherwise, technically, we should consolidate 60% if we have acquired 60%. So because we are consolidating 100% subsidiary, so we have to show, we are required to show the percentage which does not belong to us. And that is known as the non-controlling interest, which will be dealt shortly when we are doing the workings. So for group retained earnings, we have working number 5. And for non-controlling interest, we have working number 4. So this is the equity section. Alright, now we have an example. On 1st June 20x0, Premier acquired 80% of the equity share capital of Sanford. Now this is the equity of the parent. This is the equity of the subsidiary, which is Sanford. The total shares of the subsidiary is 5,000 because one share worth $1. This is the par value. So 5,000 into 80%, that means they have acquired 4,000 shares. The consideration consisted of two elements: a share exchange of 3 shares in Premier for every 5 shares in Sanford, and 8 lakh cash. So in the consideration, which is the payment made by the parent to subsidiary, there are two elements. The first element is the cash, that is straight away 800,000. So if we are taking 000, that means 800. And then there is the share exchange, which is the part of the consideration. So what is the deal? Premier, a share exchange of 3 shares in Premier for every 5 shares acquired. So how many shares are acquired? 4,000 shares have been acquired. And what is the fraction? 3 shares for every 5 shares. So the fraction is 3 by 5. The total acquired shares are 4,000, and for every 5 shares, 3 shares have been issued. The share issue has not been recorded by the Premier. At the date of the acquisition, the shares in the Premier had a market value of $5. So now you will be multiplying it by $5, because when you multiply 4,000 into 3 by 5, this gives you the shares which have been issued by the parent. And now you need to multiply it by $5. So 4,000 multiply by 3 divide by 5. This is 2,400. Multiply by 5. This gives you total 12,000. So the total consideration paid by the parent to the subsidiary for 4,000 shares is 12,800, and this includes two elements: cash and the share exchange. Now we pass the double entry. So debit cost of investment by 12,000. Credit share capital. Now you credit the share capital by the par value. So you have to split this thing into $1 and $4. All right, so 4,000 multiply by 3 divide by 5. This gives you 2,400, which is the par value, and the rest will be the premium, share premium, 9,600. So when you are consolidating the equity, what you're going to do is first of all the share capital. The already share capital is 12,000 plus 2,400, and then there will be share premium, that will be 9,600. So this is the equity that will be recorded in the consolidated statement of financial position. Now we have the last section of the consolidated statement of financial position, and after which we'll be starting the workings of the consolidated statement of financial position. So the last section is of the liabilities. First of all, we have the non-current liabilities. Straight away on line by line basis, take the liabilities of the parent, add with the subsidiary, and then you will be having the current liabilities, which include trade payables, parent payables plus subsidiary. And do you remember the corresponding payable on the goods in transit? And this was the contra entry. So this was the corresponding payable on goods in transit. We have already discussed this thing. And this is the intra group, which was the contra entry, debit payable, credit receivable. The important thing that we'll be discussing over here is the contingent and deferred consideration. Now, I have already discussed that the amount paid by the parent to the subsidiary is known as the consideration. So far, we have seen three elements. It can be cash, there can be loan notes, and there can be the share exchange. So far, we have seen these three elements. The other two elements can be deferred consideration and contingent consideration. Now, deferred consideration means that you are paying some amount now, and then you tell the subsidiary that we'll be paying you this much amount after 1 year or 2 years or 3 years. And there's no condition attached with that. When you say without condition, that is known as the deferred consideration. You're paying them some amount now, and then you tell them we'll be paying you remaining amount at some point in future at an agreed date, for example 1 year, 2 year, or 3 years. Sometimes there are conditions attached to the payment, like parent says to the subsidiary, we are paying you this much amount now, and if you take the share price up to the certain level, or your profits have been increased to this level, or your revenue has been increased to this level, or your assets have been increased to this level, whatever the condition is, then we will be paying you this much amount. That is known as the contingent consideration. Contingent means there's a condition attached with that. But the standard says that contingent consideration should be recorded irrespective of the condition being met. Like, you are not supposed to incorporate the condition. Remember, we did in IFRS 2 the market condition. Irrespective of the market condition, the expense should be recorded. So this is the same way over here. Contingent consideration should be recorded irrespective of the condition being met. Like if there is written that it is unlikely that the condition will be met, still we'll be recording the contingent consideration. But because these deferred and contingent consideration belongs to the future, so we have to calculate the present value. And we have discussed this thing so many times in IAS 16, IAS 36, many times, how to calculate the present value. So present value is future value 1 plus r raised to power minus n. And there will be the concept of unwinding as well, which you already know from the previous standards. And then there will be overdraft, parent plus subsidiary, and then there will be taxation, parent plus subsidiary. So here you have an example. On 1st August 2007, Petronic purchased 18 million of a total of 24 million equity shares in Sardonic. So 18 by 24, how much percentage it is? Let me check on my calculator. So 18 by 24. It's 75%. The acquisition was through a share exchange of 2 shares in Petronic for every 3 shares in Sardonic. Both entities have the share with the par value of $1 each. The market price of the Petronic share was 5.75. Now, this can be easily calculated. So 18 million, 18,000 were the shares. These are the shares that has been acquired. So the fraction is the acquisition was through the share exchange of 2 shares for every 3 shares. So the fraction is 2 by 3. And then we take the market price, that is 5.75. So this is the share exchange. Petronic will also pay in cash on 31st July, 2 years after, 2.42 per acquired share of Sardonic. And Petronic cost of capital is 10%. So this is deferred consideration or deferred consideration. So 18,000 are the shares which have been acquired. Multiply by 2.42 into 1 plus 0.1 raised to power minus 2. So this is the amount you will get. Alright, we can just calculate it. 1 plus 0.1 raised to power minus 2. It will be, I guess, 0.826. So let me just calculate it. 18,000 into 2.42 into 0.826. So it is 36,000 around. And the above one will be 18,000 into 2 divided by 3 into 5.75. This is 69,000. So this is how the consideration is calculated, but this 36,000 is the present value. After 1 year you have to unwind it. So unwinding will be 36,000 to 10%, which is 3,600. So that will be recorded as the finance cost in the consolidated statement of profit or loss. So this is how you calculate the contingent or deferred consideration. Alright, now we'll be doing the workings related to the consolidated statement of financial position. So there are 5 workings: 1, 2, 3, 4, and 5. Working number 1 is the group structure. Now through this working you will know how much percentage the parent company has acquired in the subsidiary. The working number 2 is net assets of subsidiary. Now you need to calculate the goodwill in the working number 3, and goodwill means how much more than net assets the parent company has paid to the subsidiary. So that means in order to calculate the goodwill, you have to first of all calculate the net assets of the subsidiary. The fourth working will be the non-controlling interest, and the fifth working is the group retained earnings. So these are the 5 workings you are going to do in relation to the consolidated statement of financial position. Now, if you remember all the previous concepts which we have discussed, the workings are going to be quite easier for you. So we are starting with the working number 1, which is the group structure. How much percentage the parent company has acquired in the subsidiary. Normally this is given in the question, but if the question is silent and there is no percentage written over there, you can simply calculate it. Number of shares acquired divided by total shares of subsidiary, multiply by 100. Now, in order to see the total shares of subsidiary, you have to go in the equity section. And when you go in the equity section, there will be equity shares. And then you see the dollar sign under which there will be the balance written. In the equity shares, it will be mentioned that $1 is the par value of the share. Now, if $1 is the par value of the shares, that means there are 5,000 shares, because 5,000 is the total balance divided by $1, so that means 5,000 shares. Sometimes it is, for example, 50 cents, or for example, $0.5. Now, in that case, this means that there are 10,000 shares. So this is the important point you need to see, that how many shares are there. Sometimes students directly pick this thing as the share. This is the balance. Now, in order to calculate the shares, you have to see this par value, and then you will be able to calculate the total number of shares. So number of shares acquired divided by the total shares of the subsidiary, multiply by 100. This will give you the percentage which is acquired by the parent in the subsidiary. So say for example, if the parent has acquired 60% shares, then the non-controlling interest is 40%. This is in the basic consolidation. Now the next working, which is very, very important, is the net assets of subsidiary. Now we'll be looking at the net assets of subsidiary at acquisition and net assets of subsidiary at reporting date. At acquisition means the date on which the subsidiary has been acquired. So net assets of the subsidiary at the date on which subsidiary has been acquired. And at the reporting date means when the consolidated financial statements are prepared. So net assets at acquisition and net assets at reporting date. The difference of these two will be the post-acquisition. Post-acquisition means what the subsidiary has earned after the acquisition. So whatever subsidiary has earned after the acquisition will be shared between the parent and the non-controlling interest according to their set percentage. Alright, so first of all, we will be taking the share capital. Now the share capital at acquisition and at reporting date, it is going to remain the same. So you just go to the subsidiary's individual balance sheet and take the share capital and write it over here. And see, this is the balance, not the share. So you have to write the balance over here. Similarly, you just go to the subsidiary's individual statement of financial position in the equity section take the share premium, and it is going to be the same at acquisition and at reporting date. And then you will be taking the retained earnings. But this retained earnings is going to be different at acquisition and at reporting date. So at acquisition means this is the pre-acquisition thing which the subsidiary has already earned, and these are the retained earnings at acquisition. And at reporting date means this includes at acquisition plus the profit which the subsidiary has made after the acquisition. So at reporting date means this is the total one, which includes the at acquisition ones plus the profit which the subsidiary has made after the acquisition. And then there will be the fair value adjustments. Now, we have already done the discussion on the fair value adjustment. It can be either positive when upward, or it can be negative when downward. And similarly, when there is upward fair value adjustment, so you are going to deduct the depreciation at the reporting date. Why we are just taking the depreciation at only the reporting date? Because when you do the revaluation, the extra depreciation is actually charged at the reporting date rather on the same day. So when we are doing the fair value adjustments, we are doing it at the date of acquisition, and the depreciation will be charged at the reporting date. So when there's upward fair value adjustment, the depreciation will be deducted, and if there's downward, the depreciation will be added back. Similarly, the unrealized profit, when subsidiary is the seller, then unrealized profit will be deducted from the reporting date. And now other adjustments, it can be either over here or at the both ends. Other adjustments may include, for example, any asset to be written off. Like for example, there is some asset which is recorded in the subsidiary's book, but now it does not worth anything, so you have to write it off. So you will be writing it over here. Any liability to be recorded or removed. In other words, if you want to record any asset of the subsidiary, or if you want to remove any asset of the subsidiary, if you want to record any liability, or if you have to remove any liability related to the subsidiary, then you can do those things in the other adjustment column, because these are all the adjustments which are related to the subsidiary. So when you total this is net assets at acquisition, and this is net assets at reporting date, and the difference between these two is known as the post acquisition, which will be shared between the parent and the NCI according to their set percentages. So remember, working to is very important, because if you are not sure what are the net assets of the subsidiary at acquisition and reporting date, you won't be able to calculate the goodwill and the post acquisition thing. Now we will be talking about the working number 3, which is goodwill. Now the first thing you see over here is the consideration, and it has many elements as we have already discussed. It can include cash, or it may be loan notes, share exchange, contingent consideration, because these two are recorded at the present value, deferred consideration. These all will be the considerations. And then you are going to add the non-controlling interest. Now again, the debate is why we are adding the non-controlling interest into our consideration, or the parent's consideration. Say for example, parent has acquired 80% of the subsidiary. So this payment represents the 80%. And as I've already told you, we are going to consolidate 100% subsidiary. We are including all the assets of the subsidiary, all the liabilities, Technically, we should take the 80%, but we are taking 100%. So for that, we will be presenting the non-controlling interest, which is the portion which is not owned by us in the statement of financial position. So when we are deducting 100% net assets of subsidiary in order to calculate the goodwill, it is not possible to deduct 80 out of 100. So you have to add the worth of other 20% as well. So when you add other 20%, it will make 100% consideration, and then you deduct 100% net assets in order to calculate the full goodwill. So this goodwill which is right in front of you, goodwill on acquisition, is actually the full goodwill, because you are taking 100% consideration and then you are deducting 100% net assets. That is giving you the full goodwill. The non-controlling interest has two methods: fair value method and the proportionate of net assets method. So if the fair value method is given in the exam, then the fair value will be given, or you just calculate it by taking subsidiary share. When you take total subsidiary share and multiply it by NCI percentage, it is going to give you NCI shares. And when you multiply it by the fair value of the NCI share, it will give you the worth of the NCI. This is the simple fair value method. Either the fair value will be given, or you can use the shares to calculate the fair value. In the proportionate of net assets method, what you are going to do is you take the net assets at acquisition, these ones, and then you multiply it by the NCI percentage. So net assets at acquisition, which is calculated in the working number 2, and you multiply it by NCI percentage and you calculate the NCI worth. So this is the goodwill on acquisition, and we have already studied that goodwill has the indefinite life, so it is going to be subject to the impairment. So there will be impairment. Now in the F7 exam, impairment is given, and in the SPR exam, impairment needs to be calculated. So impairment is simply for the calculation of impairment, you need the carrying value, and then you need to compare it with the recoverable value. So in order to calculate the impairment, the carrying value will be compared to the recoverable value, and this is the value that will be presented in the statement of financial position. And we are talking about the positive goodwill, because the negative goodwill is recorded as an income in the statement of profit or loss, consolidated statement of profit or loss. So this is the working number 3. Now there is a working number 4, which is the non-controlling interest. Now I have already told you that because we are consolidating 100% subsidiary, because we are consolidating 100% subsidiary, we need to present NCI in the consolidated statement of financial position, which is the portion not acquired and owned by parent. So how you will be calculating this? You will take the NCI at acquisition, which is the figure coming from working number 3, and then you will be having NCI share of post acquisition reserves. From working number 2, there will be the post acquisition thing, which will be shared between the parent and the NCI. And then there will be NCI share of impairment only in the fair value method, We are not going to take the impairment share in the proportionate of net assets method. So this is the NCI which will be presented between equity and liabilities, because this is neither the equity nor the liabilities. This is the portion which is not owned by the parent. And then you will be having the working number 5, which is the group retained earnings, and you will see all the adjustments related to parent in this working, because I have already told you that we are going to take the equity of the parent only. So all the adjustments of the parent. And remember, we are going to take all the adjustments which are related to the profit or loss. Anything which is related to the other comprehensive income or other components of equity should be dealt separately. So I'm going to write it over here. The other components of equity is a separate working, because this is the retained earning, the realized thing, and other components of equity is the unrealized stuff. So the group retained earnings will only show all the adjustments which are related to the profit or loss. So how are you going to calculate it? First of all, you will be taking the parents' retained earnings, and you will be taking this from parents' individual statement of financial position. And then you will be giving the parent share of the post acquisition. Then you will be giving the parent share of impairment. Again, you see impairment is the loss which should be treated in the profit or loss. That is why we are treating it over here. Similarly, unwinding of discount, which was the finance cost. Acquisition cost to be expensed out, such as due diligence fee, professional fee. It should be expensed out, not capitalized. Post-acquisition profit from associates, because I told you that it is going to be recorded in the consolidated statement of profit or loss. So anything which is related to profit or loss will be coming here. Similarly, if there is any bargain purchase like negative goodwill, that is recorded as income over here. So other gains and losses such as negative goodwill, or any gain or loss which is related to the profit or loss, and it should be related to the parent only, not subsidiary, because any gain or loss related to subsidiary should be dealt in working number 2. And if the parent is the seller, then unrealized profit should be deducted from here. So this is the group retained earnings which will be recorded in the consolidated statement of financial position. Now, this is the basic format right in front of you. There are many things, so you cannot learn all those things. Just do remember that any adjustment which is related to the parent, and the second point is that it should be related to the profit or loss, not the other comprehensive income or the other components of equity, because that has a separate working. Now, we have already discussed the unrealized profit on the goods sold by parent to subsidiary or subsidiary to parent. But sometimes the parent and the subsidiary are selling the non-current assets to each other. So if they are selling non-current asset to each other on profit, again there will be the concept of the unrealized profit. So the concept remains the same. If the subsidiary is selling that thing, the unrealized profit should be deducted from working number 2. And if the parent is the seller, then unrealized profit should be deducted from working number 5. But the debate is that how we should be calculating the unrealized profit. In the same way that group companies may trade goods for resale at a profit, they may also trade non-current asset at a profit. Again, the unrealized profit must be removed and the concept remains the same, the single entity. There's an illustration to understand that how the unrealized profit on the non-current asset makes the difference. Parent buys a non-current asset for 100,000 on 1st January 2005 and it depreciates the asset over 10 years on a straight line basis. So that means 100,000 divided by 10 is 10,000 per year depreciation. On January 2007, that means after 2 years. So after 2 years, what would be the carrying value? The carrying value would be 80,000 because deducting the 2-year depreciation. The parent sells the asset to subsidiary for 98,000. Subsidiary depreciates the asset over remaining 8 years of its useful life. Now, the carrying value was 80,000 and they have sold for 98,000. So the profit is 18,000. This is the profit on disposal. Profit on disposal. Now, the subsidiary has purchased for 98,000 and now they will be depreciating the 98,000 over 8 years of remaining life. 3 problems arise when the consolidated accounts are prepared. The profit on disposal of 18,000 is unrealized and cannot be reflected because of the single entity concept. From a group perspective, the asset must be recorded at cost less depreciation. And depreciation should be on the basis of the parent's cost. Like for example, the depreciation normally would be 10,000, which is 100,000 divided by 10. Now subsidiary has purchased the asset for 98,000 and will be dividing it over the 8 years, which is the remaining useful life. Now what should be the depreciation? What should be the depreciation? So 98,000 divided by 8. So it is 12,250. The normal depreciation would be 10,000, but now the depreciation which is coming is 12,250. So this is how it makes the difference. How to calculate the unrealized profit on the non-current asset? So the easiest way of calculating is to compare the carrying value of the asset now when the subsidiary has purchased it and the carrying value had the asset not been transferred. Now you can see simply, if this asset would not have been transferred after 3 years, the carrying value would be 70,000. That means 100,000 minus 3-year depreciation of 30,000. But now this has been sold to the subsidiary. Now this has been sold to the subsidiary. And at what amount? 98,000. So 98,000 minus 1-year depreciation, which is 12,250. Now the carrying value is 85,750. The difference between the carrying value now and the carrying value that would have been if there was no sale is the unrealized profit. And you can also calculate this way by taking profit on disposal, which was 18,000 minus the excess depreciation, which is 2250. This is the same. So this is how you calculate the unrealized profit on the sale of the non-current asset. So if the parent is the seller, it should be deducted from working number 5. And if the subsidiary is the seller, it should be deducted from working number 2. So this is another important concept that you need to remember. My dear students, now we'll be doing the consolidated statement of profit or loss. And the good thing is that the consolidated statement of profit or loss is a bit easier than the consolidated statement of financial position, because in the consolidated statement of profit or loss, there will not be too many workings which we have seen in the consolidated statement of financial position. The first thing you need to understand whenever you are dealing with the consolidated statement of profit or loss is the mid-year acquisition. If there's a mid-year acquisition, for example, the subsidiary has been acquired midway. Now, midway doesn't mean exactly the midway. It can be any month. So if the subsidiary has been acquired midway, then all of the things of the subsidiary, sales, cost of sales, GP, everything, you are going to take all those figures on the pro rata basis. That means months by 12. So this is the important thing you need to remember whenever you are dealing with the consolidated statement of profit or loss. So the first thing you're going to see is when the subsidiary has been acquired. If it is acquired midway, then all of the things including sales, cost of sales, GP, all of the components of the profit or loss are going to be prorated. Now we'll be dealing with the basic principles of the consolidated statement of profit or loss. So these are the essential things you need to understand whenever you are making the consolidated statement of profit or loss. Again, the consolidation is done on the single entity concept basis, and the consolidation is done on the line by line basis. So there are two things you need to remember. There are two bases you need to remember. The first thing you need to remember is the single entity concept. Single entity concept. That means we are doing the consolidation based on the principle that parent and subsidiary is a single entity, because the parent is having the control over the subsidiary. So in substance, this is a single entity and their financials should be presented in the consolidated way rather than presented in the individual way. That doesn't mean that the parent is not going to prepare the individual financial statement or the subsidiary is not going to prepare the individual financial statement. They are going to prepare it, but we are talking about what will be presented, what will be published. So the consolidated financial statements will be published by the parent entity. The second thing you need to understand is line by line basis. The consolidation is done on the line by line basis. Like for example, you take the revenue, parents revenue plus subsidiaries revenue. Again, expenses, parents expenses plus subsidiary expenses. And if there are intra-group transactions, like for example, intra-group interest, intra-group dividends, all those intra-group uh, balances will be eliminated and will be removed. For example, if the parent company has given the loan to the subsidiary. So if the parent company has given the loan to the subsidiary, in the parent books there will be interest income or investment income. In the subsidiaries books, that will be the finance cost. So you have to remove this thing from the parent books as well as the subsidiaries book. That means interest income or the investment income plus the finance cost will be eliminated. Similarly, if the parent or subsidiary has given the dividend to each other, that dividend will be eliminated or removed as well. So these are the basic things you need to remember whenever you are preparing the consolidated statement of profit or loss. Mid-year acquisition, I have already described this thing to you, that first thing you need to see when you're preparing the consolidated statement of profit or loss is the mid-year acquisition, because we are going to take the subsidiaries, sales, cost of sales, and everything months by 12 in that case. That means on the pro rata basis. Uh, Whenever you are dealing with the consolidated statement of profit or loss, the few things you will see, uh, including the mid-year acquisition and including the intragroup balances, is the impairment of the goodwill. Impairment of the goodwill. Now, we are talking about the positive goodwill, which has been recorded in the consolidated statement of financial position as an intangible asset and as a non-current asset. And we know that this goodwill has the indefinite life. And because this goodwill has the indefinite life, this should be tested for impairment. And impairment means there will be the fall in the value of the goodwill and due to indicators. So if there is any impairment, then that means credit will be the goodwill because the goodwill value will be reduced, and debit will be the profit or loss because this is known as the impairment. So if there is any impairment, that will be included in the consolidated statement of profit or loss. Now this is the basic format right in front of you. There can be so many things specific to the exam question, but we are talking about currently the basic format. So first of all, you see the revenue. Take the revenue of the parent plus subsidiary, but remember you have to do it months by 12 if there is mid-year acquisition. And in the statement of financial position, you are removing the intra-group balances, receivables and payables. Here you will be removing the intra-group sales and purchases. Because if the parent and the subsidiary has sold goods to each other, so for one that is going to be a sale and for other that is going to be the purchase. And purchase is recorded in the cost of sale. So you have to remove the intra-group sales as well as the cost of sales, as well as the purchases. And now unrealized profit will be eliminated as well. So if you're looking that why we are adding this up over here, the logic is unrealized profit is present in the closing inventory. And if you want to remove this from the closing inventory, you have to add that thing over here. And this thing is the fair value depreciation. If you remember from your final accounts, whenever we charge the depreciation, we usually allocate that thing to the cost of sales. So this is the depreciation on the fair value adjustments. That is why I'm calling this as a fair value depreciation. So it is on the upward fair value adjustment. If it is on the downward, then you're going to deduct it from here. So when you deduct the revenue and the cost of sale, you will get the gross profit. And then you will be having distribution cost of the parent and plus subsidiary. But remember, if there is mid-year acquisition, everything will be prorated. That means months by 12. Then you have the administrative expenses, investment income, all the investment income of the parent plus subsidiary, but you have to eliminate intra-group interest and intra-group dividend, which is the concept I have already told you over here, that if the parent or the subsidiary has given the loan to each other, so for one that is going to be interest income, for the other it is going to be the finance cost. You have to remove for both. You will be removing the intra-group interest from the investment income as well as from the finance cost. So when you take the finance cost, that will be parent's finance cost plus subsidiary, and this is the unwinding of interest which was on the contingent or deferred consideration. And then there will be the impairment of the goodwill, which is the loss you are charging based on IAS 36. Share of profit from associate. I told you that we are doing equity accounting for associate. There was one figure that I showed you when we were dealing with the statement of financial position. And now this is the other figure which you are having. Share of profit from associate. And if there is any impairment, you will deduct it from here. Then you will get the profit before tax, PBT. After that there will be tax and then the profit for the year. After that there will be other comprehensive income, like if there are any gains on investments, for example IFRS 9 financial instruments, or for example if there are any gains related to IAS 16 property, plant and equipment revaluations. Then you will get the total comprehensive income for the year. One of the most important steps that you need to remember is that this profit which you have calculated and this total comprehensive income should be distributed between the owners of the parent and the NCI. That means you have to distribute this thing between the parent and the non-controlling interest. But the biggest mistake students do is they take this figure and this distribute it on the set percentages. Now why this is wrong? This profit for the year is the consolidated profit of the parent and the subsidiary. And we have to give the profit of subsidiary to the NCI, rather the profit of parent plus subsidiary to the NCI. So if you are taking this figure to distribute, this is going to be the biggest mistake because this includes the parent profit as well. So for distributing the profit for the year to the NCI and the parent and the total comprehensive income, you have to do an extra working, and which is presented right in front of you. So what you're going to do is take the subsidiaries profit after tax from where? From subsidiaries individual financial statement. From subsidiaries individual statement of profit or loss. Multiply it by the NCI percentage and multiply it by months by 12 if there's mid-year acquisition. Then this figure is the share of profit distributed to the NCI. But before distribution, you have to do some adjustments. Now, if you are thinking that we have already incorporated the depreciation and the unrealized profit and the impairment in the consolidated statement of profit or loss, you are right. But if you see, we are taking the subsidiaries profit from the individual financial statement, and the individual financial statement, these are not adjusted. So you have to adjust these things. Three things: the fair value depreciation, unrealized profit if subsidiary is the seller, and impairment. And you multiply it by NCI percentage. The net figure you will get is the profit attributable to the non-controlling interest. So you will take this figure over here, and that NCI figure will be presented. Now how you get the parent's figure? The parent figure will come as the balancing figure. Just compare profit for the year with the NCI figure, and rest is the figure that will be distributed to the parent. Now I'm going to tell you again that don't take this figure for distribution because this includes the profit of the parent as well, and you have to distribute the parent of the subsidiary only. So you have to do an additional working. In the additional working, you will take the subsidiaries profit from subsidiaries individual financial statement. You multiply it by NCI percentage and the mid-year acquisition. Then you have to perform three adjustments if there are in the question, because these adjustments have been accounted for in the consolidated financial statement but not in the subsidiaries individual profit. And these are the adjustments of the subsidiary: depreciation, unrealized profit, and impairment. The net figure is the profit attributable to NCI, which you take over here. How you will calculate the parent's share? You just compare the total profit with the NCI's figure, and rest all the profit is for the parent. And the similar thing will be done with the distribution of total comprehensive income. So this is a technical step you need to remember whenever you are preparing the consolidated statement of profit or loss. Now, unrealized profit in the non-current assets. We have already discussed this thing when we were doing the consolidated statement of financial position, that if there is a transfer of the non-current asset between the parent and the subsidiary, there is going to be unrealized profit which should be removed. If the parent is the seller, it should be removed from the working number 5. If subsidiary is the seller, it should be removed from working number 2. But how are we going to calculate it? So if the transfer is in the current period, that means this year the transfer has been made, then the unrealized profit includes two things. The first thing is the profit and loss on disposal, because according to the single entity concept, these companies, parent and subsidiary, should not charge anything to each other. And the difference between the new and old depreciation. Remember, in the statement of financial position, in the consolidated statement of financial position, we were comparing two carrying values. Carrying value which was after transfer, and the carrying value assuming there is no transfer. And the difference between these two was the unrealized profit. But here you're going to compare the new and the old depreciation, and I told you this thing over there as well. So the profit on disposal and the difference between the old and new depreciation. And if the transfer has been made in the previous period, then only the difference between the depreciation is going to be the unrealized profit that should be removed from the consolidated statement of profit or loss. So the consolidated statement of profit or loss is quite easier than the consolidated statement of financial position. All you need to do is to remember this thing, which is the distribution of the profit between the NCI and the parent, and then removal of intragroup sales, removal of intragroup purchases, removal of unrealized profit, allocation of fair value depreciation, removal of intragroup interest and finance cost, removal of intragroup dividends, unwinding of interest should be allocated to the finance cost, impairment of goodwill should be charged, share of profit from associate should be recorded. These are the main things that you should remember, and rest will be relevant to the question.